Hi everyone, this is attorney Ben Cody from Cody Law Group, and today we're breaking down the Big Beautiful Bill, which is a tax law that affects individuals, families, and business owners, and really anyone that's doing any sort of financial or estate planning. So if you're looking for a political video on whether this law is a good law, a bad law, that's not the video I'm creating. The video that I'm creating today is a plain English overview that gives you a practical understanding on how to take advantage of the provisions that are in the Big Beautiful Bill. So if that's what you're looking for, this is the video for you. So here's what we're going to cover today. We're going to start with a quick overview of what the One Big Beautiful Bill Act actually is. We're then going to look on the tax impact on individuals and families. We're then going to shift to opportunities for small business owners. And from there, we're going to walk through planning opportunities that you might take advantage of before year end. And finally, we're going to close with some key takeaways and next steps that are actionable. The One Big Beautiful Bill Act is a comprehensive tax law which was enacted in July of 2025. Its goal was to provide long term certainty for individuals, families, and businesses. It extends and expands many of the provisions originally created under the Tax Cuts and Jobs Act, and that includes the enhanced standard deduction, the QBI deduction, and estate and gift tax exemptions that we have been working with for years. It also significantly reshaped small business taxation. We now have enhanced expensing rules, permanent bonus depreciation, and major expansions to the qualified small business stock. And finally, there are meaningful benefits for seniors, charitable givers, and people who contribute to scholarship granting organizations. There are a few big pillars to understand with the Big Beautiful Bill. First, the Tax Cut and Jobs Act brackets are now permanent. Second, the bill adds several new deductions and credits, especially for seniors and families. Charitable giving rules have been reshaped. Non itemizer deductions became permanent, but starting in 2026, itemizers will face new 0.5% AGI floor, meaning that you'll need to exceed that before charitable gifts become deductible. So, in my mind, this may change the average taxpayer's view of charitable giving to one that includes more planning rather than ad hoc donations. And for business owners, we see expanded incentives, expanded expensing, and expanded QSBS rules. Let's talk about what this new tax law means for everyday people. So first, the tax brackets you've been used to, the percentage you pay on your income, they're staying exactly the same like they were before under the Tax Cut and Jobs Act. They aren't jumping up next year like they were originally scheduled to, and that creates stability so you know exactly what you're working with. The bill also creates several new deductions, which are ways to subtract certain types of income that you pay tax on to make them a smaller number. So, for example, if you work a lot of overtime, you can deduct up to $12,500 if you're single, $25,000 if you're married. If you earn tip income, there's a similar deduction of up to $25,000 through 2028. And the standard deduction, which is the automatic amount that everyone gets, continues to rise a bit each year with inflation. And so the big picture here is that for many, less of their income is going to be taxed than it was before. Now let's talk about deductions that matter to a lot of families. So the first one we're going to talk about is the senior deduction. So anyone aged 65 or older gets an extra $6,000 deduction. If both spouses are over 65, that's $12,000 off your taxable income. But this is only available from 2025 through 2028 unless it's extended, and it's going to shrink as soon as your adjusted gross income or AGI gets above $75,000 for an individual and $150,000 for a married couple. Next, we have the SALT deduction, which stands for state and local taxes. So these would be things like property taxes or your Massachusetts state income tax. And for years, that deduction was capped at $10,000, and now it's increasing to $40,000 through 2029, which is especially helpful for homeowners or people in higher tax towns or anyone with significant Massachusetts income taxes. So it's important to note that this does not apply to investment properties. So those expenses are deducted as business expenses in full and don't count against that $40,000 limit. So if you are a real estate investor, you're still able to take advantage of the SALT deduction. And if you don't itemize, meaning you take the standard deduction, you'll now get a small charitable deduction permanently. And if you do itemize starting in 2026, you'll only be able to deduct charitable gifts that are more than 0.5% of your income. So small charitable donations may no longer lower your taxes unless you hit that floor. Credits are different from deductions. So instead of lowering the income that you're taxed on, credits reduce your tax bill dollar for dollar. The dependent care tax credit increases to 50%, which means that parents who pay for daycare or after school care should get back a bigger portion of those expenses. And the child tax credit increased to $2,200 per child, and that will continue to rise a little bit each year depending on inflation. And then one of the biggest credits that we see is for contribution to certain scholarship organizations. So if you donate up to $1,700 to one of these approved nonprofits, it has to be a 501c3 and it has to be for scholarships. The IRS will give you that same amount off your tax bill, a full credit, which means a dollar for dollar refund for that amount up to $1,700, which essentially operates as a free charitable donation to this type of organization. So it's something of free charity, which is nice. There are two other opportunities that are worth mentioning here, and the first is the opportunity zone portion of the law. Basically made that opportunity zones permanent in the tax code, and that will start in 2027. So an opportunity zone is a special geographic area where the government encourages investment and you get substantial tax savings. So if you or your advisor are looking at real estate projects as part of the mix, these might come with long-term tax benefits, including tax-free growth. Second, the rules for 529 education accounts expanded as well. So these accounts can let families save for school and pay for expenses in a tax-friendly way. And the expansion makes it easier to use these funds for private school, homeschooling expenses, or other education costs beyond just the traditional college that most people think of when they're thinking of a 529 plan. Business owners get some of the largest benefits of the entire bill. So Section 179 expensing doubles to $2.5 million. So in simple terms, this means that if you buy equipment, vehicles, or machinery for your business, you can usually deduct the full cost right away instead of spreading it over several years. Research and development expenses remain deductible immediately, which is helpful if it's a tech company, manufacturing, or if it's a science-based business. Bonus depreciation stays at 100%, meaning that most large purchases for your business can be written off in the first year. The QBI deduction becomes permanent, and so this is the 20% deduction that most business owners have taken advantage of since 2018. And if you're an LLC, S Corp, or partnership, that's a huge win. And the QSBS expansion opens up major opportunities for people who own or invest in C Corps. And we'll talk about that in a minute. So the estate tax changes are extremely important for families with higher net worth. So starting in 26, each person can pass down $15 million without paying a federal estate tax, or if they're married, up to $30 million between the couple. So this is the highest exemption that we've ever seen, and it's actually scheduled to rise with inflation. So we don't have that same problem where the exemption amount is going to fall back down unless Congress acts. The Big Beautiful Bill also didn't do away with the step up in basis, and it stays exactly the way it was. So this means that when somebody inherits an asset like a house or a stock portfolio, the tax basis gets reset to the date of death value for the person that owned it. And that's a huge win for people that inherit assets because it often eliminates or greatly reduces the capital gains taxes that those beneficiaries or heirs might have paid. And because the exemption is rising, QSBS and 199A are both so favorable. 2025 and 2026 are important years for gifting strategies and business transfer planning. So a lot going on that's worth taking a look at. So what are our planning opportunities? There are some moves that are worth considering. So I would say thinking about whether to take or when to take income and when to take deductions becomes more important. So for example, if you know your income is going to be higher next year, you may want to push deductions into that year so you get more benefit. And you want to watch for phase out. So many of the deductions and credits that we're talking about have income limits. And so those shrink as the income increases. And if you make charitable donations, 2025 is a key year because that new floor for itemizers of 0.5% starts in 2026. So if you want your charitable gifts to reduce your estate taxes now and you don't plan to go over that threshold, you may want to concentrate them before the rule kicks in. In terms of planning opportunities, this is an excellent time to review your estate plan. So the estate tax exemption is going up to $15 million, like we talked about before. So it might be worth revisiting how your existing will or trust handles that situation. Many older estate plans were contemplating exemption amounts that are much lower. At the Massachusetts level, we're still at $2 million, so we are still constrained by that, but it is worth looking at it. We also want to think about revisiting basis planning. So there was some talk about step up in basis going away. That fortunately is not the case. So if you own highly appreciated property, so if you have a rental property or stock that's grown for decades, it might be better to hold on to that property or those assets until you pass away so your family gets the step up in basis. And if you own a business, this might be the time to revisit your succession plan. The permanent QBI deduction and expanded QSBS benefits can create significant tax savings if your business will eventually be sold or passed down. For business owners, here are the things that I'd recommend reviewing. Take a quick look at your entity type. So the QSBS rules apply only to C corporations. So if you're planning to grow or eventually sell your company, changing entities could provide a pretty substantial tax benefit down the road when you actually realize that sale. So consider how to take advantage of that, as well as the QBI deduction, because it's now permanent. You can plan around it for the long term. You should also look at your equipment and capital purchases. So bonus depreciation in Section 179 allow you to write off much more than before. And if you want to become QSBS eligible, there are specific steps that we need to take early on, and this isn't something that you can just fix last minute. The SALT deduction increase may be helpful for real estate because you can now deduct more of your state and local taxes, so certain properties may become more attractive from a tax perspective. So leaving a property to an adult child who would not otherwise be able to afford the property might now be part of the plan. And remaining in Massachusetts could be more attractive now that you get a larger deduction for the income that you, or I'm sorry, the income taxes that you're paying to the Commonwealth. Also, with opportunity zones becoming permanent, some real estate development may offer long-term tax deferral or even tax-free growth that could be part of your strategy. So this depends heavily on the project and timeline. You really want to talk with your financial and tax team before doing any sort of investing in that regard. On the charitable side, one of the tools that's become even more useful under the new rule is something called a donor advised fund. If you've never heard of it before, here's a simple way to think about it. A donor advised fund is like opening a charity investment account. So you put money into it now and you get the tax deduction immediately, but then you can decide which charities receive your money in the future. So the big beautiful bill changed the rules for itemized charitable deductions starting in 2026, like we were talking about. Because of that floor, it might make sense to make your charitable donations over the course of a couple of years. And then, so you bundle them together and then you get your full tax deduction when you make that gift. So you can spread out your actual donations to nonprofits over time, and it makes your records a little bit easier because now you just have one deduction rather than separate receipts, so to speak. It's also great for people that want to give to charity but aren't sure exactly which organizations they want to support yet. And then scholarship granting organizations now give a full, or you would receive a full tax credit up to $1,700 if you make that type of gift. And then finally, 529 plans have expanded uses, which allows families to apply even more expenses towards those funds. So that include elementary school and homeschool expenses. So the key takeaways are the Big Beautiful Bill is the biggest change to taxes we've seen since the Tax Cut and Jobs Act in 2017. It creates opportunities for seniors, families, charitable givers, real estate investors, and small business owners. And the biggest benefits come from planning early, structuring things correctly, and timing your decisions. Now is the time to review your estate plan, your business structure, and your gifting strategies to make sure that they're all on point. So now that we've covered the major opportunities in the Big Beautiful Bill, the natural question is, what do you actually do with this information? So the first step is to talk to your tax professional before the end of the year. Because this law changes deductions and credits now, it's something that you have to do during the 2025 tax year. We can't just wait until next year to deal with this. Your tax preparer, your CPA, can actually run projections to look at how the new deductions would affect your taxes, and you can make smart decisions about timing, withholding, and year-end moves. The next step is to look at your estate plan because the exemption amount changed and perhaps your charitable gifting strategy changed, as well as your business succession plan might have changed. This is a good time for us to take a look at your plan. And then the third step is to look at your overall financial and investment strategy with your advisor. Especially true if real estate, especially opportunity zone investment, is something that you're focused on, or if you own a small business. And keep in mind that small business under this code means anything under $75 million in revenue, which really captures the vast majority of all businesses in the United States. And then the new SALT deduction limit and the opportunity zone rules and changes to QSBS, the permanent 199A deduction, all these can influence how you invest, how you sell your business, and how you structure your business. Also, what kind of tax savings you might be able to capture. So, this is a great time to talk to your tax advisor, your financial advisor, your legal team. Make sure that we have a comprehensive team in place so you're protected. So, if you don't have that in place, reach out to me. I'm happy to introduce you with folks that I work with that I think would do a good job in helping you navigate these issues. So, the biggest takeaway should be this: don't wait until next year. Uh, Operate in tax year 2025 if you're going to make changes to your plan. So if you have questions about how any of these changes affect you, your family, or your business, we're here to help. One of the things that I love most about my work is that I get to help people and I can help them understand complicated topics in a way that is a little bit more digestible and can be broken down. Because every family is different, every estate plan is different, everyone's business is different, you really need a team of professionals that can offer you tailored advice for your particular situation. And part of that is understanding how this new law applies to you. So if you've heard something today that sparked a question, or you have something lingering in your mind that you want to know more about, feel free to reach out. I want to thank you for taking the time to watch this video, and I look forward to helping you and your family maneuver the big, beautiful bill.